TGIF, everyone. Hi, Didier. Thank you, Kevin, Arena, everyone else. So here's my look on S&Ps. Everyone see that? So we held a very important support level yesterday. Just drew this line, extended the triangle line out and adjusted a little bit. So what are we going to have, a right shoulder? Or is there enough time before the cycle ends to get one more high? Actually, when I look at the 15-minute, it almost looks like a breakout here. And this whole formation was about 45, 50 handles here from, 40 from here to here, or if you just take it from here to here and then tack on a breakout, there is a shot for new highs, but this is looking like a 2 on a week. On a week, we're lower, but we didn't take out or close under the off number, which was tested yesterday. So these off numbers are pretty important. It was at, sure, Didier. The off number was 38.92, and we took it out by about 7 handles. So we're not getting a 2-week reversal, even though we're 11 handles lower on the week here. Dollar really gave up the ghost after that rally from 61.8. Almost looks like we could have this from here. That's going to take us back down towards the lows. There's your daily. Looks pretty ugly to me. That's just another little bear market rally, and we start closing under 90.12 to 61.8. I don't know why we wouldn't be able to take out these lows, maybe head towards 88.50. Euro proved itself in the last couple days. Looks like another flag, doesn't it? This was a flag for 1, and then we have 2, and this is a flag, and so we're probably headed to new highs there. In Euro, I know cables led it all the way, but Euro looks like it's going to, we're going to have another wave. Aussie, real strong. The only thing I could say about this on the Aussie is even though we've made new highs and it's an explosive Friday, look at this. I didn't think we'd confirm at new highs, but all the other momentum indicators are confirming. There's your 4, there's your 2. So pretty lousy week in the dollar all in all. And the dollar was pressured against all currencies across the board. So here's something I am looking at. I have been for a while. I'll share it with you, and maybe it's going to come into play next week. Check out this formation in Canada. So at new lows on a daily, we're not going to confirm, and the bottom of the wedge line is, I think, another 60 pips or so. I have to extend it a little bit, but this looks like a ending diagonal if I'm a Elliotician, and it's coming in around 125. It looks like 24.90. So one thing I can say, and it's marginal, but Aussie's making the new high, and Canada is not making the new low yet. Okay, so in some respects, even though it's ugly and it's an ugly day, that's a little subtle sign with Aussie making a new high and Canada not yet making a new low. And I'll wrap it with the yen, US dollar yen. Looks like we have 2 drives up here. This one I tried at 521. We're actually back under the off number. Really came off quite a bit from the highs early this week. So doesn't look great either. But when I look at it from here, it looks like we've had one, we've had two, and maybe we have one more push up. Oh, and oil looks pretty much the same on the 4 hour. I remember someone was saying they thought that this was drive one, and I didn't think so. And then they thought this was three up here. I didn't think so, but now it looks like one here. I mean, we are diverging, but it's over 70. Should crude pop above 62 sometime next week? I don't think it's going to uh, get over an RSI reading over 70. So this would kind of make sense. One more high in the energies and one more high in S&Ps, maybe sometime early next week. Hope everyone had a great week. And if you're new and you haven't been here for a while, consider joining us so that you have all this research at your fingertips. I want to thank everyone for their attendance. We have Peter Riley here today. We have an interview today. So I'm going to pass it over to Blake now. How are you today, Blake? How's it going, buddy?
So we have an interview today.
Yeah. And next Friday, a very special interview.
Yours truly.
Yeah.
Who?
Yeah. Stell.
It's gonna be Friday. Great to have Stelios here, but I didn't know we had an interview today. I didn't see it on the.
Yeah, I Skyped it to enter it. It's a makeup for that day my internet was down.
Oh, okay. All right. Well, you were asking me how I was doing, and yes. I'm gonna say not so good. I didn't expect the Aussie to break into new highs. And so it's turned a lot of my crosses upside down where I had, really good profits overnight. And, it's like, you sit there overnight and you're like, I got a nice profit, I'll be fine. And then you come up and everything's upended and it's like, man, par for the course, right? Business. But that's how I feel today with the Aussie rally at this moment. So let me go ahead and share with you guys. One thing I'll come back to that one here in a second. But yeah, you can see the Aussie, we came out of an ascending wedge. We were pulling back. We pulled back to like the 38% retracement. And, just looking at the Aussie, you're like, okay, well, it's struggling to make new highs, even as, stocks are kind of struggling here. Yeah. And then they just blew up overnight. When I got up and I saw that we were trading above 78.20, I was like, what? And I'm sure it's catching a lot of people, everybody in North America that's sitting back in front of their computer right now is looking at everything going, oh my God, I can't believe, it's the Aussie's ripping like this. And it's not just the Aussie. You can see the Kiwi has tried to break the 78% retracement now, and the Kiwi might catch up. The dollar Canadian slumped to trend lows. Now, keeping in mind, we are now trend lows, but we do have retail sales today. And I look at equities and it's like, I don't know if it's just a catch up with equities moving here, or if we're, trying to make an actual move in the Aussie, and the S&P is going to move into new highs as well. It's tough to say, but I was genuinely very surprised when I got up this morning and I saw the Aussie trading where it's at. But just keeping an eye on equities. One of the things that we talked about yesterday is talked about how important these support levels were. I'm surprised when we broke through 38.90, we didn't come all the way back down to 38.70, but we probed, and you can see how we just actually hit the spike lows from, a week and a half ago. I know some of you are probably looking at this saying, oh, hey, we got a head and shoulder pattern. So, that's something that's setting up. As far as I'm concerned at this moment with the Aussie breaking out, I don't know if I would be thinking that. You know what I'm saying, Coach?
Yeah, I think that they're probably, if we're going to get a new low for the move in the dollar, that should be supportive for risk. I don't think that. I think we have to look for the dollar to, be showing signs that it's going to rally for the S&P high. And
yeah, unless
going home this weekend,
like the Aussie and the Kiwi and the Canadian show like some false breakouts, today, I would not be thinking that right now.
Right.
With the Aussie as strong as it is, that's from an FX point of view, that is where you have to be looking at the risk, the risk association with the Aussie. So as the Aussie continues to strengthen, that is more of a tailwind for equities. It's equities thinking, okay, there's the reflation trade. You got copper moving higher. You've got the Aussie moving higher. So stocks should continue higher, right?
Yep.
Now, here's the flip side to that. Here is the other thing that I can't, shake either, is the dollar Mexican peso. Look how strong this is, Coach. Now, you would think that the dollar Mexican peso below, at these levels would be, coming down quite aggressively with stocks where they're at.
Yeah.
But it's not. And especially with the dollar. I mean, look at the cable. The cable's above 140 and continuing to take stops higher. Aussie's, trading higher. So the dollar Mexican peso is, I mean, it could trade down today, of course, especially from current levels. We might actually start, pushing lower here.
It's an outlier, the canary in the coal mine.
Is it a canary in the coal mine? And that's the question that you got to ask yourself. It's like, is it right now?
I thought Putty Cat. Oh, that's Tweety, right? All right.
Yeah, I mean, is that the way we should be viewing it? But the thing is it's not just the dollar Mexican peso. It's like, look at the rand. I mean, the rand is holding up pretty well too. And that's, again, is it a canary in the coal mine? Is it really just a bunch of noise? Is it just going to catch up? I don't know, but I think it's worth, keeping on the radar and knowing that they are holding up pretty well in this environment, which they shouldn't be in all actuality. In all actuality, the US dollar Mexican peso should be a lot lower. But these warnings haven't meant a thing either. Because, if you look at the dollar Mexican peso over the last 2 months, it has been stabilizing, but it hasn't been signaling, look, stocks are going to roll over. Because what have stocks have been doing? They've been continuing higher, and the Aussie continues higher, and commodity currencies continue to be strong. Commodities continue to be strong, generally speaking. So, it's not it hasn't been a quote unquote sign as of yet. So, but I think it's just worth noting. It's something that we have to pay attention to. Speaking of one last thing, I should probably talk about is I should talk about gold and silver. And I don't know if you talked about them this morning. I had to step away to go grab some coffee.
I didn't, buddy. Go ahead.
You didn't? But look at gold. Look at how weak gold is. I mean, we got a bear flag pattern going on, but look, we're tagging these. This is pretty important support. This is one of the breakout points. And it's like, why isn't gold going higher? And I really sit here and wonder, Dale, and Stelios, you might be able to chime in, and same with Steve if he's here. I'd like to open this up to conversation with you guys. Maybe this is really the start of something much bigger for gold and silver, as
yields.
Investors are shunning, like, why do I need this rock when I can just store everything digitally?
That's the big.
What are you storing digitally, though? That's the only basic question I have.
Risk on anybody that wants any type of safety. They're flocking to Bitcoin. So we're seeing this diversification, in my opinion, away from a rock, paperweight, into digital stored currency.
But the difference is that it's not paperweight. gold and silver didn't become currency arbitrarily. They became for the very simple reason that they have all the properties that money needs to have. They are divisible, of course, not as easy as electronic money. They are globally, since 5,000 years ago, acceptable. Why? Because they are rare, and most importantly, because they have actual properties which do not diminish by time. Still today, we use gold that might have been mined or anyhow found thousands of years ago. You make it a jewelry, fine, no problem. You don't like the jewelry anymore. You melt it and you can use it in electronics next day, tomorrow.
Steve, no, I understand I understand all the properties of that, but for our generation, the generation moving forward, like if you're my kid, right? And your son for that matter, now minus how you're going to try to alter your son, but think about like your son's friends. As they grow the next 15, 20, 25 years, are they going to prefer what they perceive as a digital currency, or are they going to say, well, I'd like to really store it in gold?
Digital currency is a different thing. Bitcoin is not a currency, right? It's not you can't use it as a currency. You can use it to buy stuff, but it's not really a currency, is it?
Well, yeah, okay, a store of wealth. Let's just
store of wealth, yeah. Well,
or even an inflation hedge. If that's the case, then things continue to get more expensive.
Yeah. It's an alternative.
I'm just saying that is that what we're seeing? You know,
that's what Gunlich, even Jeffrey Gunlich said something like that yesterday, that the funnel, it's a smaller funnel, so it doesn't take as much money to move it. And there are a lot of people that are, espouse what Blake just talked about. I don't buy it, but it's, that's what's happening now. Doesn't mean that's the way it's going to end up, but that's what's happening now.
I think Blake has a very valid point, and I think the younger generation definitely are attracted to this. I have my daughter-in-law and some of her friends and some other kids that I know from family. They've all asked me about Bitcoin. Oh, I want to buy this. I want to buy that. I said, yes, okay, perfect, buy it. Just why are you buying it? And they all said, oh, I want to make money. I want to sell it higher.
Yeah,
that's what they all say.
In that case, go for it because it moves higher.
Yeah, I said, go for it. You can do that. You can double it, triple it, quadruple it. Go for it. Just as long as you know what you're doing. That's all.
But what I'm trying to say is maybe that this is the mindset that's starting to catch on now. The mindset now is, oh, well, I don't even have to sell it. Maybe it is a store of value versus, gold. And that's what I'm saying. Maybe we're seeing the shift where gold is weakening now as Bitcoin is rallying.
Since when do young people think about storing value and wealth?
No,
young people don't think like that. Old people think like that. Young people think, I want to make money because I have dreams. I have a specific car I want to buy. That's going to get me my dream girlfriend or whatever from like university or what else. What I'm trying to say is that the people that are really attracted to cryptos at the moment are mostly people that their mindset is, I want to make a lot of money quick, and not people that are like, how do I store my wealth for the future?
Yeah, I mean, my son, after he becomes a YouTube superstar with 400 bazillion followers and making $10 million a year, he needs to store his wealth somewhere, and he thinks Bitcoin, not so much gold. I'm joking about that.
It's a fair point, actually.
But it's a topic worth exploring, because really we're not seeing gold and silver rally with the rest of the commodity complex, even as inflation expectations continue to rise. And I am a little worried. Technically, I'm not worried about them yet, but I look at silver. That move last night, that was in Asia. It just took out all the stops. But what I would really be concerned with is if silver traded below 25, that would be very concerning to me. Gold, gold to me looks like we're going back below 1700.
It is likely.
And I'm not saying it's going to happen today. I'm just saying.
No, it is likely. Technically speaking, I think we're still in a prolonged correction because gold has had a major move higher, right? I mean, lasted a long time, a major move higher. And the market currently, for some reason, I mean, the market more frequently thinks wrong things than right things. I mean, we've seen that multiple times. The market currently seems to be of the idea that the rise in yields is negative gold and silver, which is purely BS. The reason I'm saying it's purely BS is two things. First of all, real rates are still extremely negative. How do we know that? Just look at TIPS, that the Treasury inflation protected securities. I mean, if you see the difference between the yield in TIPS and the normal 10 years, you'll see that the implied real rates are -1%, minus 90 something base points. So we're still talking about negative rates, and some people think that the Fed is going to raise rates soon. I mean, they've clearly stated, and they believe them, that they're not even thinking of raising interest rates.
And I mean, yeah, with the all the spending that we've had, I mean, I don't know how they're going to be able to service their debt if rates go up anyway.
It's a vicious spiral, Blake. Think about it. Rates are currently raising. Why are they raising? It's a simple demand and supply issue. How many real investors want to own treasuries? In my opinion, very, very few. Okay, so what's the problem now? The problem is that they've not expanded once again. They've not had a big leg higher in the Fed's balance sheet, but with the 1.9 trillion package coming through, etc., you'll see, in my opinion, that rates are going to move down again. Why? Because the only method the Fed has of solving the rates issue is doing what actually makes rates want to go higher, printing even more money, funding even more of the debt, so they can actually buy back those bonds themselves and push yields lower, because the US and the vast majority of the developed countries cannot afford higher yields in what is unsustainable debt. So it's funny, but the problem begins because more or less, if you let the market free and alone, it understands that everybody's more or less insolvent. And the insolvency issue, they're trying to fix it by making countries even more insolvent by printing more money. And it works. And it will keep on working until it stops working. And when it stops working, it's going to be fireworks all over the place. But until that happens, you'll see that this yield scare, I think, is going to be again temporary, because once the Fed prints another 2-3 trillion to buy all these bonds, because they're going to buy them all. I mean, they're going to buy, if not 100%, they're going to buy 90-95% themselves, and the rest are going to be bought by institutions that will just want to front run the Fed from buying them, so they can sell it back to the Fed again and make the difference.
So you think this move in yields, this is not sustainable?
No, I think that at some point yields are going to explode higher in a way that's going to be, spectacular, but we're not there yet.
Got it. All right. Well, I'm going to let you guys take over the screen, and we'll see what happens. I'll let you talk about some things that you want to discuss. But I think it's worth noting that gold is trading really heavy, silver is trading really heavy, and cryptocurrencies continue to outperform, and yields continue to push up. So and actually, I was talking to Kevin Ferry, who you guys might remember him from CNBC years ago, and I've brought him on as guests over the years, but he actually is in wine country now. I talked to him yesterday actually for about 45 minutes about a lot of different things actually, but one of the things that he was also mentioning about the bond move, because he is a big bond trader for so many years. He was always on CNBC for 20 years, every morning, at when I was on my morning drive. So it was like just before the market opened, he'd be from the Chicago board of, the CBOE. And
before he was pre Rick Santelli.
Yeah, pre-Rick Santelli, he'd, every morning he'd be on the floor. I'd listen to him every day. And anyway, I've gotten to know him over the years. And
he thinks this is a big deal, what's happening in bonds.
Well, he thinks the bond move, the easy money was made. He's like, he'd been short bonds.
Okay.
Basically, if you look at the 10-year, he'd been short since October, since around here.
Yeah.
And he thinks that the easy money's been made, but he's not necessarily believing that, that bonds can't go lower. He's just like, I don't know if I really want to trade them at this point. Anyway, I'm going to let you guys, Steve, I'm going to let you take over and
have a good weekend, Blake.
Yeah. Thank you guys. Have a great interview. I will see you. Those of you on the Face 2.0 webinar in about 45 minutes. All right. See you guys.
Bye-bye, mate. So still, Dale.
Yes. I think I want to mention our friend Laura says something about cryptos, something very accurate. What do young people do? They're on social media all the time, right? So she's saying cryptos extensively and easily marketed in young people through social media and apps. Not the case.
I agree 100%.
Very, very good point, actually.
I agree 100%. That's why it's not easy to call the top. But in my opinion, as with all bubbles, this generation is also going to learn its lesson, as the tech generation learned its lesson in 99, 2000, I mean. A lot of people are going to lose a lot of money in cryptos. Even people that have been making a lot of money, those that are convinced that the way to go is hodl, as they say, they will probably end up only with past paper profits at some point in cryptos.
Well, that hodl strategy was for GameStop as well, right? They were saying, I'm going to 1,000 and 10,000, wherever.
Needless to say how many obviously lost their money there, right, Celio? And whoever really believes that GME is ever going back there, I have a bridge to sell you. Come in Greece, I'll show it to you.
Yes. Okay, what else is there to mention? I mean, there's been some good news about the COVID vaccines in the US. Apparently, they're going to double the amounts that they were planning to have. So it's gaining traction, and we have 3 or 4 different ones now. So people are getting vaccinated, which is definitely good.
I think they're doubling it by only giving people 1 shot. Isn't that what they said?
Is it? Oh,
I think they're because I think Pfizer came out and said that they have 90% efficacy with 1 shot. And so because there's a shortage, and I've had 1, that they may not give people the second so they could give others their first.
If the numbers are true and with 1 dose you have 90% efficacy, it makes sense.
Yeah, that's
mathematically
what
speaking,
I heard
it absolutely makes sense.
Yeah.
Yeah.
And everyone's going to need a booster anyway.
I mean, it's much better to have double the people with 90% efficacy than have half the people with let's say 98% efficacy, right?
Right. That's what I heard. Anyway.
I'm going to ask, since you mentioned it, Dale, I'm going to ask my doctor friend that's into it today and let you know on Monday.
All right.
If that's the case.
Okay.
If indeed it has 90% efficacy from the first dose, because obviously he doesn't know, what the US is doing. I mean, that's a local thing there. But having to do with the efficacy of the vaccine, he will 100% be able to tell me.
Cool. Elsewhere, we had some data today. It's amazing. The Aussie move and the Kiwi move and retail sales in Australia missed by quite a bit. But clearly the market doesn't care. Retail sales in the UK missed by a massive margin.
Give me a second, Stelio. Learn a lesson like the tech generation did. How did the hodlers of Amazon, Microsoft, and Apple get on? How was their share price compared to your precious gold? Seriously, you believe there are people that owned Microsoft, Amazon, and Apple in 1999? And they kept on to them after an 80% or 90% downturn? And they still have them today. Yeah. Okay. What's the percentage of people you think held on to those stocks at minus 80% from their highs? Just give me a number. What's the percentage, like in your mind? Like 80% of the people you think, for example, held them through 80% losses?
Forget about people who were leveraged because they were stopped out anyway.
They were stopped out.
They didn't have the, yeah, DDS says 1-2%. I would say
yeah, exactly,
some 5%.
exactly. That's a number. So what happened to the 98%? That's the question. Because I'm not doubting that some institutions held on to them 98% when they were 80-90% lower. I do believe it, but what's the percentage of investors that in total?
Obviously, not everybody bought at the top. You know, they buy lower as well. But that move,
yeah, the problem, Stelio, as we all know, is that the retail crowd buys very close to the top. That's the problem. The retail crowd buys near the top. And to be frank, it doesn't matter if you bought 10% from the top, because even if you are at some point 10% in the money, then you'll find yourself 70% out of the money and nobody holds.
Yes. Okay. Dale,
I know it from experience from Greece as well, because during the same time, globalization, we had the same type of melt up in stocks.
Yeah.
I mean, stocks with zero real value were just like leaping higher on a daily basis. Personally, 9 out of 10 people I know, at some point they had big paper profits. We're talking about people that initially invested something like, let's say in today's prices, 30,000 euros or 50,000 euros. And at some point they found themselves in the money with the equivalent of 500,000 to 1 million. And they were like, I'm a millionaire. And 9 out of 10 I know either left at break even when they had lost any hope that they're going to make back their money. And some of them even lost their initial deposit. I actually know very, very, very few people that cast out rather close to the high and they were like, okay, I'm out. That's it. I think it's good. Right. I've made well.
Yeah. Okay. Let's bring the guest
we're
in
bleeding into the interview, and
sorry, I thought it's Friday. I thought we didn't have an interview.
I have one. It's okay. Peter, how are you, buddy? Welcome to Face. Glad to have you here.
I'm here. Can you hear me? Okay.
Can you turn it up just a little bit, buddy? The volume.
I think it might be okay, Dale. Sometimes the microphone needs a few seconds, to auto adjust the volume.
All right, you're good. You're good, Peter.
All right.
All right. So good morning. Very nice to meet you again. Sorry about that day. I didn't have internet service. It was just, a day. Poor people in Texas that still don't have power. Can you imagine having leverage positions on and not being able to do anything? I have some, trader friends there. So let me ask you, Peter, you're going to share your screen, right?
I will be glad to, yeah.
Okay.
So
is that green box?
Yep, yeah, I got it. I cannot start screen share while other participant is sharing.
Yeah, Steve, you have to stop sharing.
Done.
Thank you, buddy. Okay, Peter.
All righty. Hopefully you guys can see that.
Okay, so you prepared. You told me you had a PowerPoint. So before we get into the PowerPoint, Peter, can you just give me a little history, how you got involved in trading and forecasting, etc.? What was, say, for example, your first gig in the trading business?
So I am not a professional trader. I'm an actuary and economist by training. I spent most of my career in health insurance, actually, as an actuary. So became very facile at financial model building. And in fact, my father's a statistician. I'm versed in time series. So I come from it, from a
DNA. It's in your DNA.
Yeah, I was programming matrix inversions at 13, with my dad. So
right.
So I've come to it more from from an adjacency. Okay, so it's more of a passion. So what I did was eventually, I lost, made some money back in the .com bubble, lost money. I felt like I was not really knowing what I was doing in the market. I didn't have a process, a system. I looked for processes and systems. I had a boss at the time who was doing the same thing, because he was interested in the markets. And ultimately, I backed away from, kind of like the trading approach where I'm going to allocate my capital because I think this about that company. But eventually I came upon, using my technical background in model building, financial model building, a way to design an allocation scheme that's systematic. And it got me thinking about the nature of systematic investing. And that's really kind of what I was coming to the table to talk about a little bit today is, systematic investing and how traders can think about what they're doing within that context. And I know that doesn't, most traders probably don't think that they're actually running a system, or people like you are sharing your screen and showing charts really think that they're, using a system. But in fact, it's my position that everybody is. What they just haven't done is necessarily programmed it or set it down in rules and a heuristic. So that's kind of what I was coming to the table to talk about today.
Okay, great. All right, so I'm open. We learned from everybody. Appreciate you preparing a presentation for us, Peter. So take it away.
So first of all, I have to say that I am and my partner are in the middle of raising a fund. This is not in any way a solicitation to join the fund. My lawyer made me put this in, so
okay.
I want to be clear.
We've got your disclaimer. Okay.
Got my disclaimer. So let's talk about the characteristics of systematic investing. It's systems are rule driven, no discretion, numeric representation of a core allocation thesis. Okay. So traders and even chartists are doing that. They just haven't got down to the point where they're necessarily laying it out in a heuristic. So I was watching you with your screen, showing trend lines, and I've done the same thing. And every trader, everyone who is visually oriented, likes to look at things that way. But you could theoretically go and program exactly how those lines should be drawn. Okay, and when the line should be changed, and what conditions would make you want to sell or buy based on the structure of what your logic has created. You're just doing it in a very shortcut way. People are visual, but there's nothing stopping anybody from taking what you were doing there and turning it into a system, and then ultimately proving its worth by backtesting, by application to multiple scenarios and environments, and demonstrating that you can generate returns that are in excess of the market by doing that. So the approach that I've kind of taken to thinking about what I'm doing, and the concept that I really want to get across today is that price movement is the opportunity. Okay, and the goal for any investor should be to capture as much price movement into their returns as they possibly can. Okay, and there's multiple ways to go about doing that. You can create a system or a process that you apply on occasion when the probabilities are deemed to be in your favor across different asset classes or stocks within an index or stocks across indices or paired trades. So there's many ways to capture all the price movement that occurs in the market. And the goal is to capture enough of it so you're exceeding the returns of the market, with regularity. And I don't want to say risk adjusted because I'm not necessarily a believer in the efficient market hypothesis and that construct, but that's really the goal. So price movement is really the opportunity. And I think about systematic investing in terms of systems or processes that can be demonstrated to produce value over different time frames, and then stacking those processes. Okay, so let's say that I have a model. Buy and hold is a system. So you enter at point X and you get out at point Y. That's a system. You capture only one part of price movement, If you have a trend following model, it may tell you to be long now, be short now, be long now, be short now, and you have an opportunity to capture much more gain into your process. If that system works, then buy and hold. So the concept is to find processes that work over different time frames, stack them, meaning unbound yourself between keeping your portfolio between 0%, in anything and 100%, long. So the opportunity to use leverage where leverage is in your favor is also a critical concept. So illustrating that, this is just a simple example of, hey, I bought on January 2013 and now I've got these gains, buy and hold. If you had a trend following process that said, hey, the momentum of the market is fine, it's fine, I'm long, and then here it says it's time to get out, okay, and I go short. Either you get out or maybe even go short, you've captured that price movement, whereas a buy and hold system only captures the point-to-point, gain. So it's not a terribly complex concept, but the more granular your processes get, the more price movement there is to take into your system, okay? The corollary is that systems that are neutral to the market are obviously to some degree missing opportunity because it doesn't have a position on the price movement that's happening.
Right.
And the more granular you think about this and you get to the point where you go, hey, high frequency trading, what are they doing? They're getting down to the
milliseconds,
the subatomic level of the market and capturing mini gains at high frequency, that in price movement. And so you can start from that very granular level all the way up to the macro and talk about how you can stack processes and that are orthogonal or independent to gain more than the market. So that's the concept that I really wanted to talk about today. I'm going to stop there and see if you've got questions or anyone else has questions.
Okay. I know you have a presentation. Does it include that you have models, proprietary models that forecast secular changes in markets?
Yes.
Okay.
So that's the first system that I built was what I'll characterize as a mean reverting valuation driven model. So it's an allocation scheme that says the higher the market is valued, the less you want to be in the market. The lower the market is valued, the more you want to be in the market. And obviously that's buy low, sell high. That's obvious, right? But the point being is that it actually, if you unbound yourself from thinking about, hey, I want to be only 100% long, there are opportunities understanding valuation to know that you actually should be levered long to capture high probabilities of gains. One of the principles embedded in this is that in general, if the market isn't suffering, if the underlying economy isn't suffering from persistent declines in corporate earnings power, the market just has a tendency to get more expensive until that occurs. So there's a tendency that the market goes up, and the more undervalued it is, the more levered you should be. And as you get more overvalued, eventually you should be out of the market and even short. Okay. So this scheme is driven by a proprietary valuation model using corporate profits from the national income and product accounts that the government publishes. And so the basic concept is that equities valuation should be a function of the size of the economy, nominal GDP, and how much corporations are pulling out of the economy in terms of earning power. And I don't just mean S&P 500 companies, I mean the entire economy. And one of the conceits of the model is that the observation that the government data on corporate profits actually often disagrees with what companies are publicly reporting, because companies can publicly report their earnings more favorably than they really are from an underlying economic perspective for some period of time. One of my roles at a large health insurer, which I won't really say publicly because you can find out, was to be the valuation actuary. Okay, so you're making estimates of what your earnings are, and you, at any point in time, you can keep fat on your balance sheet. You can have reserves that are overstated, and then as things kind of like you miss your estimate, well, you can change that fat, and you drip that out into your P&L, and you hold your earnings up until the point in time where you have no more fat in your balance sheet. Okay, and so when secular turns in the market occur, it happens because the underlying earnings power of corporations are declining persistently. Publicly traded companies won't recognize that that's a persistent trend for some time, and they will do what they need to do to hold up and meet their earnings expectations. Up until the point in time when it's obvious to everybody that, hey, we're in a recession, corporate profit margins are plummeting, and then everyone gets a free pass to admit that things aren't that good, and then they have a kitchen sink quarter and so on. So the way that goes back to my model is that turns in corporate profit margins in the NIPA data actually lead turns in publicly reported margins by a full year. And that allows you to create a structure so that if you observe that, you should be shifting your allocation scheme. And that's exactly what this graph here is showing, that in my model, when my logic says, hey, this is ripe for a secular bear market. And what I mean by a secular bear market is something that lasts, we'll call 9 to 18 months and is punctuated by persistent declines in corporate profitability. Then your allocation scheme in my model is still a function of relative valuation, meaning how cheap equities are or expensive they are, but they shift to a much more conservative stance. So that's
okay.
the model.
So what's your model saying in these market conditions and structures? Based on a valuation model, would you say there's not that much value left in the market with valuation levels and rates going up?
There is not much value. In fact, there is no value left.
Okay. All right. So your valuation driven model would be how much in cash?
Actually, it's 100% short.
Okay. That's that's definitely a statement. Okay. So how long have you been 100% short? Is this a recent position that you've taken with the model?
That's actually since November.
Okay.
So it's obviously taking a drawdown, which is a characteristic of a mean reverting scheme. Yeah. So the concept is that the markets can in fact go higher. I can't say when it's going to turn. It's you take drawdowns, but you position yourself to capture that. Now that kind of leads to why I'm working with another model developed by a partner that's more price momentum oriented. So that price momentum oriented model makes decisions on much shorter time frames and goes between, flips between long or short. And that model in and of itself as a standalone model performs very well. But when you overlay it on top of my model, which is a mean reverting, valuation sensitive model, they actually, the gains, compound between the two models. So said another way, a price momentum model says it's okay to be long right now. So if my model is 100% short and the price momentum model is 100% long, that effectively makes me flat to the market as opposed to literally being short. So that's the concept that I want to get to, is that you can take two independent systems that as long as they're uncorrelated in terms of decision making and time frame that they work on, and that means you can then overlay those two systems and take the gains of either system into your price movement.
And your shorter term system is called a momentum system, Peter?
Yeah, it is. It's my partner Dan Weiser, who you can also find out there on Twitter. Developed this. I I helped him kind of turn it into a process, but the concepts are his, and it's very much like based on RSI 5 and other internal measures of market strength. And so it's literally a logic-based process where it's a if then else decision. It's not Dan looking at the day and saying, hey, today I feel like being short, or look, I think this is really a long. It's a logic-based process. Then you could then back test and demonstrate the value over time.
Okay. And what would you say allocation would be between the two models? Equal?
So that's what's a little different, and a lot of people think of it that way. We're not going to allocate capital between them. The two models actually work together. So the allocation stacks on top of each other in our process. And we plan on capping leverage at 2 times long and 1 time short. But so, for example, if my model says, hey, it's 50, I'm 50% long, and Dan's model says it's a short right now, we would actually be positioned at 50% short, not 100% short and not 50% long, and vice versa. So right now, the stacking is that my model is says short, his model says long, and that makes us neutral. So it's not an allocation between the two models. It's actually stacking two uncorrelated processes, allocation schemes on top of each other.
Okay. So so then you probably have a lot more conviction about the shorts when the momentum model would flip and you'd be on on the same page. And we've had some sell-offs, and I do some momentum work, and definitely I mean, there's been all kinds of momentum divergences and non-confirmations. Is his model close to flipping back the other way to short?
I do not have Dan's probably on the line.
Okay.
But to think of it this way is that if it takes probably 2 to 3% decline off of the top prices to really even talk about the possibility of it starting to flip short.
Okay.
So it's the market's got a little work to go, but frankly, once it goes short, the potential for more meaningful declines are there because of valuation. So think of it as the conditions are ripe for meaningful declines in prices, and that once momentum says that the market is no longer actually trending, that enhances the potential for that. Doesn't guarantee it.
Nothing's So Peter, let me ask you this: when you talk about mean reversion, with the S&P's trading over 3,900, does your model tell you what mean reversion is ahead of time, or once you get there?
No, see, that's the one thing about mean reversion. It's not predictive, okay? It's about positioning for it and having a process to allocate appropriately for the tendencies of the market. And that confuses a lot of people who are more trading oriented, because you think you have to be making calls at any time as to whether or not you're the market's really a buy or sell, and if you lose money and take drawdowns, you have to stop out of it. This process has no stops. It's a continuous allocation scheme. So mean reverting means that if the market continues to go up, you get shorter. Now in my model, because of risk control, I do cap at 100, at 1 time short. The market can get more irrational, and you can go bankrupt levering short. You're way more likely to get rich levering long than you are levering short.
Okay, and how do you participate on the short side? By actually going out and shorting individual issues or ETFs? What's your approach for playing the downside? What kind of instruments you use?
This is purely S&P 500 market timing.
Okay. Okay. So if you were short, you could be short SPYs?
Yep, options.
Okay.
Everything's been different. Options have different instruments have different risk characteristics. In a mean reverting model, you don't ever want your position to be taken away from you. Meaning, so probability of ruin is a very important concept in doing mean reversion. So you have to use instruments that you control. So I have personally favored options on S&P 500, on SPY. It also, that requires, obviously, as price moves, delta moves. So since we target market exposure, you have to constantly kind of like, kind of titrate, exactly what the exposure is to the portfolio. So if market says, hey, you're 150% long and the market goes up, and you're using options, well, the delta goes up. So that means that you need to titrate and sell options to get back to your 150% long position. But futures don't have that characteristic, but futures are way more tax efficient and way more kind of leverage efficient. Problem is that you can run out of margin, right? So it's, I use a mix of instruments depending on the circumstance. Okay. So for example, in March of last year, I was not touching options because of the high VIX. Even if you were right, as VIX came down, you were likely to give your gains to somebody else. So I was at that stage using levered ETFs, again, because the margin characteristics. So it really depends on the characteristic of the market, what instrument makes the most sense.
Okay. So Peter, we have a few minutes left. Anything that you want to wrap it with, and perhaps you want to show if you have a website or where people could reach you if they want to delve more deeply into what you're doing?
Yeah, so the only thing I wanted to share was two things. Okay, so this graph shows what our historical combined model allocation has been, with the darker orange being the historical daily allocation. You can see that we've got to be short at this point. We were longer on the dip because valuation came down enough, but right now valuation is such that it says to be short. Did capture, into a neutral and then short position this decline back here, and you can see that that's back in the early days, because valuation was so low in 2013 and 14, the model was generally levered long. The last thing I wanted to share is the characteristics of the returns of the combined strategies, which in back testing is, and even though I've been sharing my stuff publicly for 2013, Dan's model is pure back testing. The combined models have pretty attractive characteristics in terms of return, but also Sharpe and Sortino ratios relative to the S&P 500 and drawdown characteristics as well. So I just wanted to share that. I will be glad to make the presentation itself available. I'll just have to, I don't know whether you guys like to put stuff up on your website, but otherwise I'll be glad to put it up via my Twitter feed somewhere along the way.
Okay. Well, I really appreciate you coming here and sharing what sounds like and probably is your life work with us today.
Well, this is definitely my life passion. So, I enjoy being an actuary, but this is really what I love to do. So,
you action junkie. All right, I'm just kidding you. So it was great meeting you, Peter. You're now my trading warrior brother. I wish you much success, and may all your signals work out eventually.
I appreciate it.
All right, so Peter Riley, everybody, and here's his contact information. Peter Riley, K Riley, which is his handle on Twitter. There you go. Take a screenshot. Okay, they're thanking you, Peter, for being here. And I appreciate you spending your most valuable currency, which is time, a half an hour with us on Face to, tell everyone what you've discovered over your career, especially with your background, your mathematical background. So thanks again, Peter.
Oh, my pleasure.
And everyone have a great weekend. Enjoy, do your work. Peter, don't you find you really see the markets much more clear on the weekend when they're closed? Some of my best trades are, done on the kitchen table over the weekend. And then you're just prepped to execute.
It removes the emotion of the real-time decisions that traders make.
Yeah. No impulses. That way you help. If you have it planned, you're less likely to say, "Hey, that looks okay. I'll give it a shot." So again, Peter, have a great weekend, and we'll be in touch. And that's a wrap, everyone. Thank you for your attention. Remember, don't just count your returns. Remember that reversion to the mean is being grateful. And so don't just count your pips, count your blessings, and we'll see everyone Monday. All right. You're welcome, Leon, Sinatra, everyone. That's a wrap. I'll see everyone on Monday. Adios.